Mr. Frampton, you ready to join us?
I'm trying. Can you hear me?
I can hear you.
Okay. I don't know if you want to see me.
All right. How are things in Georgia?
Good.
He's not related to Peter Frampton, is he?
I wish I wouldn't be listening to you guys now, would I?
So Scott, I got 5:34.
Yeah, let's go ahead and get started.
Okay, great. So first of all, I'd like to thank everybody for joining us tonight or this evening, and especially thank Scott Forehand for taking the time out of his busy schedule to put this together for us. Just a little bit of background about Scott, if you don't know him already. Scott's an agency owner with Symmetry Financial Group. I've known Scott for going on 2 years now, buddy.
Yeah.
And really, I really like the way he looks at things from a business perspective. But when it comes to debt-free life, he's he's taken this to a little bit of a new level. Just to put things into perspective, he started about 10 months ago, along with the rest of us, doing debt-free life for our clients. And he's protected nearly 100 families, helping them get out of debt, to the tune of about, when the plans are fully executed, to the tune of about $70 million of debt that's going to be retired, and improving their retirement situation to by nearly $150 million. This is a guy who understands this better than most. He's the one who trained me. And I certainly appreciate you, Scott, for taking the time to, share and not only share some information, but also entertain some questions, from us out here. One last request of everybody, if you wouldn't mind muting yourselves out so we don't have any background noise. And Scott, you're going to announce when there's like a Q&A in the end, right?
Yeah.
Okay. Anything else you wanted me to go over about like putting the tray tables up and get your seat into the upright position, locking your seatbelts and anything?
I think we're good, and I'm sending you the money for that intro right now.
Okay, great. Well, listen, without any further ado, Scott Forehand.
All right, thanks, Tom. So, hi, everybody. My name is Scott Forehand. As you heard from Tom, I'm an agency owner here at Symmetry Financial Group, and we're here today to talk about debt-free life, what it is, what it can do for you and your family, not only in the near future, but permanently. If you're here, you're because you were invited either by a Symmetry agent, underwriter, or broker, or because you're with Symmetry and just trying to get a better feel for this particular product that we have, or you're one of my clients and I'm trying to show you something that I think would be appropriate for you. So we're going to do this virtual presentation. This is also something that we're actually doing virtually, just in the field right now. And when I say in the field, I mean we're actually sitting at home working, doing Zoom appointments to actually help people get these policies and these plans in place. So what is debt-free life? Debt-free life is really what this is. This is a plan, and it's a plan that is designed to help you take care of two of your biggest hurdles. Everybody here has these. You have some debt. Maybe it's in the form of a mortgage or something else, student loans, college loans that you're helping your kids out with, who knows? And maybe you're looking at retirement, and maybe thinking to yourself that maybe you need to look at something a little bit different than what you've been told with a traditional 401k, 403b, whatever. So in a nutshell, what debt-free life is, the way we're going to show you today, this is really a battle plan for you to combat debt and get out of debt. And it's going to, in the end, provide a safe, secure, and tax-exempt retirement, which is a critical component about what we're looking at today. So these are two questions that we ask everybody when we start thinking about whether or not they're a candidate for debt-free life. And to be honest with you, to date, I've only met one family that wasn't a candidate for debt-free life. And don't need to know why. It's just they weren't a candidate. And the questions are simply this. Are you 100% certain that your retirement is going to be solid? And I don't think anybody can say that. And if I could show you, or if we could show you, Symmetry could show you a way to get out of debt in 9 years or less, is that something you would be interested in hearing about? And of course, everybody wants to hear about that. And you'll hear this over and over, or you'll think this to yourself, this is too good to be true. And I'm just going to preface that whole thought process with this. It is too good to be true until you understand it's just math, and the math doesn't lie, and the math works, and these work on guaranteed premises, contracts from the carriers that we work with to provide this service for you. So this is where we're at. This is almost everybody here, an average American household. We've got about 3% of the money that we have is going into savings. So that's for future, that's for retirement. About 34% of what we make is going in to pay interest. About 40% of everything we make is going to pay taxes in one form or another. And what's left over, that 23% sliver there on the top left-hand corner of your screen, that's what we live on. That's what we pay our power bill with. That's what we put food on the table with. That's what we take our vacations with. And this is not the American dream. And this is not the promise that our forefathers had in mind when they set this country up. So if this is you, kind of like this is me, which is this is me, then you are the average American. If you're the average American, you have debt. If you're the average American, you overpay your taxes. You pay too much in taxes. And if you're the average American, you're not saving enough for retirement. So what we're going to do here with the debt-free life plan for you is we're going to fix the three big problems you hear. Mainly, if you look at that one combination between taxes and interest, that's 74%. 74% of every dollar you make is either going to pay your debt service, the interest on it, or it's going to pay tax. That's too much. So here's the average American. The problem with our company or with our country is not that we don't make enough money. We make plenty of money. The average American makes $2 million in their lifetime. Problem is we're not saving enough. And why aren't we saving enough? And it's what we just talked about. It's because we're paying too much in interest and too much in taxes. So if there was another way where without having to go out and make more money, but just change the way you spend money, and that's all we're talking about here. We're not talking about creating a new bill for you. We're talking about changing the way you spend money. There is a better way that we could change this equation around and get you from that average American where you only have $600,000 or $60,000 at retirement to where the average DFL American is going to have $300,000 in retirement. You'll be much, much better off. So this is the traditional approach when you're looking at how we look at debt. When you go talk to people that are the quote unquote experts of how to get out of debt, they're going to tell you to work harder, go get a second job, spend less money, refinance your debt, consolidate your debt, go out and eat ramen and tuna every night, that kind of stuff. All those things are old school. All those things kind of work over time, maybe, but it doesn't have to be your choice. That one down there at the bottom is interesting. Let's talk about that for a second. Debt snowball. This is not a new concept, but what most people think of as a debt snowball is inaccurate. What most people think of as a debt snowball is actually what's called debt stacking. And what that means is you take a look at your debt and you fill out a budget and you look at, I've got this credit card at 29% interest, this one at 28, and this one at 25. And your knee-jerk reaction is going to do the debt snowball, which is actually debt stacking, where you're going to actually pay the highest interest rate off first, and then come back and pay the next one, and then come back and pay the next one. And in theory, make yourself have more money in the end. And that system fails most of the time. There's always, let me preface this whole conversation with one thing. There is always a best way or a best order to pay off your debt. Always. There's always one. There's only one best way. Whatever that way is, where you come up with at the end of the game or at the end of the run when you've got the most amount of money left over, that's the best way to do it. And more often than not, it doesn't use debt stacking. It's usually a true debt snowball. We'll talk about that in just a minute. So here's our better way. If we can show you how to eliminate that debt in 9 years, most people out there have a 30-year mortgage. If you've taken out student loans or you're helping your family members, your children or your grandchildren with student loans, you're probably on the hook for almost 40 years. There's a better way to do it. And this is what we're going to talk about specifically today. We're going to increase your cash flow. We're going to decrease the amount of money you pay in taxes. We're going to decrease the amount of money you pay in interest. We're going to increase the amount of money you keep for savings. And all the while, we're going to pay your debt off a heck of a lot faster than you thought it was possible and create a much, much more solid retirement, tax-free, not tax-deferred like an IRA, but tax-free retirement in the end. So let's look at the two solutions side by side. So if you're the traditional American, this is you on the left. You've got about $250,000 worth of household debt. That's in the form of cars and credit cards and student loans and personal loans and mortgages and second mortgages and all that stuff. If you are on that path, then your American dream will be what we showed earlier. You're going to make good money. You're going to make a lot of money in your life. And eventually you're going to retire. And you're going to retire with around $60,000 in your IRA or in your 401k or whatever pension you have. And you're going to be reliant on that and Social Security, which may or may not be around, to provide your income for you. This is relying on the government. And, whatever you think pro or con about the government, all I know about them is that they have a tendency to try to overspend. And they're putting us all into a problem where our Social Security is going to be at risk. So when I counsel with people on these particular solutions, I absolutely take into consideration the fact that they've got Social Security potentially in their future, but I also do not count on it, and you shouldn't either. So when I look at these two solutions going from left to right, when I look at what the traditional American does versus what our debt-free life program does, pay particular attention to a couple of things. First off, that savings on the left side where we're going from 3% to on the right side where we're moving up to 15%, that means we're changing that from 3 pennies out of every dollar you make to 15 pennies is what we're having in our savings for our retirement. And just to emphasize this point, that's a 500% increase in your retirement. And one of the things we said earlier is I'm not telling you to go out and get a new job. I'm not telling you to eat ramen. I'm not telling you to default on your debt. I'm not telling you to do any of that. I'm just saying there's a better way to spend your money. And that's what this system is. So I'm going to increase, or whoever invited you here is going to help you increase through your debt-free life program, help you increase your retirement by about 500%. Over there on the right, the interest rate, I'm going to reduce that interest rate from 34% down to 22%. That's a huge decrease in interest, right? And that's over time, of course. But at the end of the day, where's that 12% go, which is actually 35% reduction in total interest paid? Where's that money go? Well, it's either going into one of two places. It's either going into your pocket or it's going into your bank. Either way, you're much better off. You still get to keep that money. Look there at the bottom, 40% taxes down to 30% in taxes. That's huge. That's a 25% reduction in the amount of tax you're going to pay over time. Same question as before. Where's that money go? Well, it's either going in your pocket or it's going in your bank. Either way, you're much better off. Actually, in your bank is even better because then the money's working for you over and over again. And last, I want to look at that last piece there, that last piece of this pie, the lifestyle piece. You're moving from a 23% average right now, where you're at right now, to a 33%. So that's a 10% increase, right? But no, if you do the math, that's actually a 43% increase in the amount of cash you have at the end of every month. Okay, so what are we doing here? We're decreasing your taxes, we're decreasing your interest, we're increasing your retirement, and we're increasing your cash flow. And we're doing that. So think of it this way. You know what your budget looks like right now. And you know how much money you spend every month. And you know how much money you've got left over every month. What would that look like if you had 43% more left over every month? What would your life be? And again, we're not setting up a new bill for you. It's not a new debt. We're just changing the way you spend money. Okay. So let's move on. We've got some more stuff to show you, help illustrate this. So this is our goal. This is what we're trying to do for you. If you execute this plan correctly and you follow the system and you're disciplined about it, you're going to have more money than you ever thought possible. you'll be able to weather any financial storm, any recession that we're headed into, or we're actually already started, or depression, actually. Any pandemic, any good president, bad president, any war that affects the country, doesn't matter. You'll be able to go through all of it. And you won't have to go ask cousin Vinny to borrow money. And you won't have to rely on the federal government, Uncle Sam, to send you a stimulus check. It won't matter. You won't have to go to the bank to ask them if you can get a reduction in how much payments you have to make on your car payment for a while. It doesn't matter. It won't matter. And also, as a byproduct of this whole thing, again, not that it matters, your credit score is going to shoot through the roof. So when we do these debt-free life plans, we don't care what your credit score is right now. This is not a credit-based thing, okay? But what the end result will be, if you execute one of these plans, in about 2 or 3 years, your credit score should be up in the low to mid 800s. And then the banks will be falling over themselves to try to lend you money. And then it won't matter, because you have your own bank. And that's what we're doing here. We're setting up a private bank for you. And you won't ever have to worry about trying to borrow money from the bank for a car, for a house, for a vacation, whatever you decide that you need to borrow money for. One other thing, there's some other solutions that are out there that people talk about. And this uses a couple of critical concepts. One's called infinite banking, which has been around for a long time. And the other is called debt snowballing, but true debt snowballing. A lot of the systems that are out there that use a loan to do this would be something like take out a home equity line of credit against your home. Those are nice in theory, but for me personally, I don't see any reason in the world why I should give up equity in my house to go pay off a credit card or to go pay off a car, even though the interest rate's higher. But that credit card and that car doesn't have any right to the equity in my house. And if I do that home equity line of credit method, then I'm basically doing that. I'm trading equity in my house so I don't have that debt. Not good in my book. So what we do is completely insulated from all that kind of stuff. Moreover, with the screen that we're on right now, this 80-20 rule, those home equity line of credit plans or second mortgage plans or anything where you're borrowing money plans for the infinite banking side of this, they all fail in one critical piece, which is that what if? What if something happens and you can't work for 6 months? What if something happens and you lose your job? What if something happens and the house burns down? Who knows? All I'm saying is there's lots of what ifs out there. So what we do here, our system, we plan for that what if. We plan for that unexpected issue. So basically what I'm saying here is about 20% of the money that you have, it's going to be invisible. And this plan will generate that 20% emergency fund for you without you even thinking about it, without you knowing about it, without you looking at it. It's there. It's growing. It's growing with a guaranteed interest rate and a dividend, but it's not there for you to play with. It's there only as a true emergency. So when the time comes, if you end up needing access to that, this is the critical part where you have to be the banker and you have to say, is it a want or is it a need? And if it's a need, then you can go ahead and do it. But we're going to advise against touching that unless it really is an emergency. Moving on. So a lot of you out there, myself included, have had retirement vehicles, 401ks, 457s, 403bs, whatever, TSPs. That's great. And the promise that we were all told was that we could stop paying tax on that income right now so that we could avoid in our tax return this year and pay tax on it later. That's what we were told. And that's the way those things work. We were also told that the tax bracket would be lower when we retire, which is probably true. But what we weren't told, or what we were told incorrectly, is that the amount of tax we're going to pay is going to be less when we pull it out. So we're all going through this pandemic together. We've all seen how much money the federal government is spending, and they're getting ready to try to spend more. All that money's got to come from somewhere. It's going to have to get paid back. The only way they're going to be able to pay it back and rescue Social Security on top of that is they're going to have to hike up our taxes. And how much, I don't know. But what I do know is the tax that you pay on income today is going to be less than the tax you're going to pay on the income in 5 years, because they're going to have to pay that money back. So what we've looked at here, taking that into consideration, the schedule of where we are as a country and what we're looking at, where the problems are going to be financially, is we know that the old IRAs, 401ks, even the Roths, okay, those were great when they came out. And the information they provided to you back then when you took those out were great guesses, but it is not the case. And when you compare the performance of a 401k, a traditional 401k or traditional IRA, to this vehicle, using the exact same numbers, a $10,000 investment, a 28-year return, a 7% average interest rate, which ours is actually higher than that, and at a 25% tax rate, there is no way the math will work to show you that 401k is going to outperform this. Actually, I've run numbers of 401k performances, including different indices, the Barclays Index, S&P 500, the Janus 250, all these different indices. They all do well, but they cannot outperform with regularity this system, because this system doesn't care about the market. We don't care. We don't care whether the market's going up, down, or sideways. We're going to make money every day. We don't care. So if you look at those first two columns, the tax-free versus the tax-deferred column, that's the difference, really, between a 401k and this vehicle. So the last one of these illustrations I ran, just for example, I looked at a 20-year run of how this vehicle with a guaranteed interest rate performed when you're paying your tax up front, because that's what we're doing, versus a 401k where you're paying your tax on the back end when you pull the money out. 17 out of 19 years, this vehicle outperformed the other vehicle. That means 3 years out of 17 out of 20. That means 3 years out of 20 years, the 401k did actually outperform this. Okay. But then in the end, this is not who's better each year. This is who's better over long term. And when I look at the long-term performance of this vehicle versus the other vehicle, the answers are stark. It's very plain. This vehicle always outperforms over time a standard or traditional 401k. And if you have any doubts about that, and you're looking at you've got a financial planner that you work with or a financial advisor that you work with, fantastic. Ask them this question: can they guarantee that you're going to have this return? And they cannot. And they will not be able to guarantee that. So that's one of the key differences between what we do versus and how we do it versus the way that the financial planners and advisors. Their information is great information. That's how they're trained. I'm not saying that they're giving you wrong information. I'm just saying what they have to offer, unless it's one of these, and this is Debt-Free Life, which is proprietary to Symmetry. So nobody on the planet's offering this except for Symmetry right now. Then they can't perform the way that we do. Moving on. So this plan exists in 3 phases. It's the maximization phase, the accumulation phase, and the distribution phase. So let's talk about each one of those. What is the maximization phase? Maximization is what we do in the beginning to set you up. That's the development and execution of the initial phase of this battle plan. That is us looking at what debts do you have, what's the interest rate, how much are you paying, what are you overpaying, what are you overfunding as far as 401ks and TSPs and all that stuff. There's all kinds of places where we can make recommendations where you might be able to use some money to fund this thing. But the maximization part is to eliminate the debt. That's the whole piece. It's the whole goal. If I can get your debt gone in 7 years versus 40, then you're way, way ahead of the game. And if I can do it without you spending more money than you're already spending, you're even further ahead of the game. And if I can make it so that you get to keep that money, this is critical. If I can make it so you get to keep the money that you would normally have spent to pay your debt, then what happens? Your debt still gets paid and you win. That's what this is about. Accumulation. So accumulation is where we've gone through the debt elimination process and you're debt free. That's great. Okay. And now we're building on that huge retirement. with the effect of not only the premiums that we were paying, but also the effect of the dividend that's coming in every year, whether we get out of bed or not. And also the effect of that guaranteed 4% interest rate that we're going to get that gets compounded monthly, I might add, which is huge. Okay. So there's some strategies we're going to talk about a little bit later, but that's one thing I just planting the seed now. The 4% interest rate is compounded monthly. Critical. And the last is the distribution phase. This is how do you take the money? So if you have a 401k, your way to take the money is you have to wait until the IRS tells you to. Or if you get to 72 and you don't need the money, they're going to make you take it anyway. And if you don't take it, they're still going to send you a bill for the tax on what you should have taken. Okay. So the point is, with a distribution on a traditional retirement solution, you're at the whim and at the mercy of the IRS because those products exist under IRS tax code. Our product exists outside the tax code because our product is based in life insurance. So that means, and we'll get into that in just a few minutes, but the whole idea is the distribution, when we take the money out, it is tax exempt. It's not tax deferred. It's not tax advantaged. It is tax exempt. Every dollar you take out of this account, whenever you take it out, and you're not limited to take it out after you retire, by the way, okay? Every dollar you take out of this account is tax exempt. Whether you, and we'll talk about that in a minute, but there's no way that you're going to be able to take money out of this vehicle once you start it where you're going to end up owing a tax, where you're going to have a tax obligation. All right, so again, the three phases: maximizations, getting you out of debt; accumulations, growing that nest egg as quickly as we can, as large as we can, using the effect of premium payments, compound interest, dividend payments; and then distribution, that's when we're sitting on the beach in Tahiti and taking our money. All right. It's not a good picture for me, is it? Sitting on the beach in Tahiti? That's not a very good visual. Sorry, guys. Anyway, as I was mentioning, this is something that's been around for a long time. This is not new. Infinite banking is a concept that's been around for hundreds of years. These are some people that have done it in the past. Walt Disney did it when he started Disney World. Doris Christopher did it to start Pampered Chef. Ray Kroc did it multiple times with McDonald's, and Warren Buffett still does it today. The concept is this, is that I'm going to use money from something that makes money, but then I'm going to keep using that money over and over and over again. So this is not new. This is not anything that's out of the ordinary. The only trick is, until Symmetry came along with Debt-Free Life, this solution wasn't really available to the mass public unless you had a whole lot of money, because you had to be able to go to a private insurance company and get them to create one of these specialized insurance vehicles for you. And so all that's happened here with Debt-Free Life is that there's a number of insurance companies that have been talked to, and 3 of them have agreed to create these solutions that are available to us, the mass public, and we don't have to have millions of dollars to be able to play in this arena anymore. Now you have to have $100. $100 a year is the minimum. Just in case you were wondering, it's awesome. Okay, so moving on. So what we're going to be doing here is, and I've already mentioned this, we're not creating a bill for you. We're just changing the way that you spend money. And the way that we do that is by redirecting inefficiently used money. We're going to allow your cash value to grow. The growth is going to be both guaranteed as well as non-guaranteed, which is actually a dividend. When we pull money out of this, we're going to be borrowing money. That's how we do it. We don't actually take out principal. We take out borrowed money, and I'll show you that in just a minute. Does it work in 9 years or less? Well, I've done a whole lot of these, and that 9 years or less is kind of misleading. It's actually, what I've seen is 15 to 27 years less than what your normal debt service would be. So if you've got a 30-year mortgage and that's all you've got, worst case scenario, I'm going to get you out of debt in 15 years. I'm going to help you turn that 30-year mortgage into a 15-year mortgage without you spending more money than you're already spending right now. If you've got that mortgage plus a whole bunch of other debts, it's probably going to get down to about 7 years. And if you've got a whole bunch of debts and you're overfunding a lot of 401ks and stuff like that, the shortest one of these I've ever seen is 2.3 years. So that's why I was saying it's not really 9 years or less. It's really 15 to 27 years early is the way that should probably read. This we already said it. We use loans. but the policy itself is designed to pay off those loans automatically for you. So you may not be able to stroke a check for the loan amount that you've taken against the policy, but you don't have to, because the dividends and the guaranteed interest rate are going to pay it off for you. We use this. This is just a plan. We talked about that before. It's just a battle plan. And we all know that battle plans don't survive contact with the enemy. So in this case, the enemy's debt. So whenever we run into that debt monster, then the plan may change. It probably will change. And we know that that's going to happen. And that's okay. Life happens. So you may need to put a new roof on your car. You may drop a transmission and have to go replace that transmission. It's okay. That's what this account's there for. You use it. Just pay yourself back. That's the only trick. If there is any trick to this, the trick is to pay yourself back. So if you were going to have to pay $20,000 for a new roof, then you're either going to borrow it from a bank or you can borrow it from yourself. And I'd rather borrow it from myself at 0% interest than borrow it from the bank. So that's the concept here, is that you become the banker and you lend yourself the money, just pay yourself back. Last, down there at the bottom, a legacy. By default, this is going to leave a legacy for your family. And that's certainly one generation, either your spouse or your children. But if you structure these correctly and you fund them properly, you can create generational wealth. I don't mean something that's going to make your enough money so that your child can go to college. I mean, you could do this so that your grandchild would be able to buy a house if you do it correctly. Okay. And that's not just me. That's any of the Symmetry agents that you work with can show you how to do that. So these are some of the people that we worked with. These are nice. 84,000 paid off, 100,000 paid off, 73,000. They're just numbers. And like anything else, the numbers can be influenced by you, by how diligent and how disciplined you are with the system. And they can also be influenced by how aggressively you've financed and fund this system. All those are your decision. It's all up to you. All right. So your Symmetry agents are going to show you different ways. They're going to show you different options, and that's great. And ultimately, it's you that has to make the decision. And one more thing I want to say about this. A lot of times as an agent, when we structure these vehicles, we're going to look at what the most amount you could possibly spend is going to be. And that may be uncomfortable for you. It's okay. The application, when you do these, you should actually apply for what that biggest number is. And the reason why is because when we go through underwriting, they have to underwrite for a specific amount. We can always come back, but we can't go any higher than that. Okay. So shoot for the stars. If you decide to do one of these plans, figure out the most amount you could ever do, submit your application at that level. And then when the time comes after the policy goes through underwriting and they get everything done, and they say, this is what we're willing to offer you, that's when you make your decision. How much can I afford? Okay. That would be my first suggestion. That's what I do with a lot of my folks. And then, maybe it's only half, and that's fine. What we do as Symmetry is we don't really care what you spend. Our goal is to get you out of debt and to get you on the safe track to a solid retirement. So moving on, let's talk about how you spend money. So this is the current way you spend money. You make money. You work your job, gets paid out to you. That money comes and gets deposited into your checking account, whether that's with Wells Fargo, Citibank, whoever you bank with, it doesn't really matter. That money sits there. Your money gets put into the bank, right? Then what happens? Well, then that bank uses your money over and over and over and over again. Do they pay you for that? In most cases, no. If they do, it's a pittance, okay? How often do they use it? They use your money every night. So the average dollar that you put into your bank, your Wells Fargo, your commercial regular business bank, whatever bank you use, they use that dollar 7 times. They make money with your bank with your dollar 7 times, and they earn crazy interest rates, anywhere from 1% to 29% with your dollar. And at the end, they don't pay you anything, usually. So let's say you move forward in this process, and now it's time that you need to pay off one of your debts. So when you do that, you either write a paper check or you tell the bank through bill pay or whatever you use to go ahead and pay my Visa card, pay my power bill, whatever it is. And in the end, that money that you transfer out of your bank becomes their money. So your money has gone from the left side of this equation to become their money, and your money is gone forever. And if you're really, really nice and really sweet, and you ask in your best voice, can I have that money back because it's really, really tight right now? They're going to laugh and say no. And that money's gone. It's not your money anymore. You're not getting it back. This is the standard American model. This is what all of us have been taught to do. And it's what we're brought up on, and it's what we know. It's also wrong. And here's why. The debt-free life method works. Well, it works. It works so much better. So you start off in the same scenario. You make the money. That money gets deposited as income down into your bank, into your checking account. But here's where the debt-free life method differs. We're going to make that money make a detour. Okay, and the way we do that is simply by writing a check to our debt-free life policy. Okay, and that policy, that money comes from that checking account. It goes up into that whole life policy. So debt-free life is actually, it's three parts. Okay, it is a whole life insurance policy that has a term life rider and has a paid up addition rider. That paid up addition rider is where the majority of your money actually resides. It is not a bank in the fact that you can write a check against it. It is a bank in the respect that it is storing cash, it is growing, and it is going to create that huge retirement for you in the end. But let me back up for a second. So the initial payment that you're making, that one arrow coming out of your checking account down at the bottom of your screen, that's one payment. That's all you're making, is writing one check. When that check hits the carrier, it gets split up into three parts. The first part is to pay that whole life insurance policy premium. Okay, that's what the whole thing is built around. It's built around a whole life policy. Whole life policies are characterized by a couple of different things. Number one, they're permanent. Number two, they grow cash value, many cases slowly. In our case, it's fast because we're getting a guaranteed 4% compounded monthly. All right. And it may or may not have a living benefit or two with it. The living benefits for what we're doing here are irrelevant. It's a non-discussion. But one of the other things this policy has, from some of that money gets split, it gets split into a term life rider. Why? All right, and this is where we get into the taxation side of this. The IRS tax code 7702 says any monies derived from a life insurance policy are tax exempt. So if I die and my wife receives my life insurance benefit, it's tax exempt. If I take a loan from the cash value of my life insurance policy, it's tax exempt. If I pull principal out of my life insurance policy and the amount of the principal does not exceed the basis, however much I've spent in over time, then I'm basically taking my money back, and it's tax exempt. So in theory, there's no way you're going to be able to pull money out of this vehicle where you will have paid in less cash, or where you're not going to be taking it out as a loan. So in all cases, when you're deriving money from this vehicle, it's tax exempt. IRS tax code 7702 also says if the cash value of a plan exceeds the life insurance value of a plan in the first 7 years, that it is not a life insurance policy. It is then called what we call a modified endowment contract. And at that point, this is all over, because everything becomes taxable. Even the money that you put in there pre-tax, you've already paid tax on it, is still going to be taxable when you pull it out. So our goal as brokers, agents, and underwriters here at Symmetry, when we structure these vehicles, is to create a safe plan for you that you'll never be able to put to the point where it becomes a MEC, modified endowment contract. You'll always be able to get way more cash out than you put into it, and you'll be taking out in a tax-exempt manner. So we're protecting you on the short term, midterm, and long term. The way we do that is that middle piece, that term life policy, the term life rider. When we create this vehicle, it's going to have a whole life base face value. The amount is irrelevant. The term life rider, however, is huge. And the reason why we do that is because we want to be able to grow that cash up underneath. And that term life rider creates this umbrella. this umbrella that guards us from the IRS intrusion. The IRS can't see beyond that umbrella. They can't see financially what we're doing inside this plan. And the last thing that I talked about was that paid up addition rider. And this is where we're growing, and we're growing a lot. So every single payment that you make is going to be somewhere between 62 and 68% permanent paid up addition life insurance. That's what that paid up addition rider is. So let's talk about that for a second. What is a paid up life insurance policy? It is exactly what it sounds like. It's a life insurance policy that you never have to make another payment for once you make the first payment. How much is it worth? It's worth whatever you pay for it. So if I ask you this, if I give you $1,000 bill right now, how much is it worth tomorrow? It's worth $1,000. How much is it worth next Friday? It's worth $1,000. How much is it worth 10 years from now? It's worth $1,000. So think of that paid up addition as $1,000 bill. I wrote a check. I paid my whole life insurance policy, of which 68% bought paid up additions. Whatever that 68% was, let's say $1,000, I just bought $1,000 of additional life insurance that is there permanently. So let's talk about that. What is that? That's an asset, okay? $1,000 cash in your account is an asset. $1,000 gold bar in your coin collection is an asset. A $1,000 life insurance policy that you never have to make a payment on again is an asset. Okay, just like if you had paid for your burial policy in advance, that's an asset. All right. So when we look at assets, there's different classifications of how weak they are, how risky they are. In this case, a paid up addition life insurance is considered the safest investment on the planet. Why? Because it's never going to lose value, and you don't have to do anything to maintain its value. All you have to do is stay alive. And when you pass, when the big man gives you that call, then your family receives that benefit and you don't lose a dime. So every time we're making these payments, 68, 62, 68% of that payment is going up into paid up additions. The rest of it is funding that term life rider and the whole life insurance policy, which is also growing cash value over time. So what do we do in this process of making our life insurance payment? Follow the bouncing ball here, guys. We moved the bank's ability to make money with your money for whatever portion we moved up into our private bank up here. And now we're making money with our money in our DFL bank over and over and over again. So we've transferred the ability for the bank to make money with that money and put it in our pocket. So we're using our life insurance policy that's insulated from IRS intrusion. One more thing. That life insurance policy is a contract, just so we're all on the same page. There's multiple benefits for contracts, but one of the benefits is if I have a contract with you and my friend wants to sue me because he walked onto my property and broke his leg, he cannot sue me for the life insurance policy. It is what we call tort proof. So you can't be sued. A federal judge can't order you to vacate it. The IRS can't attach a lien to it. You don't ever have to worry about somebody telling you to drain it to give somebody money. It is life insurance, and they can't do that. Okay? So moving forward, so you've got your money up into your DFL bank, and your money's earning money over and over and over again. How much is it earning? It's earning a guaranteed 4% compounded monthly, and it's earning a dividend. The dividend is based on the performance of the company. The three companies that we use are all what is called a mutual company. So there's some tax advantages for mutual companies. The tax advantage is they pay less tax. The trade-off is they have to pay out more of their profit to the shareholders. So the three companies that we use for this are all mortgage companies, which means the dividends that they pay are higher than what you would expect. For example, one of our carriers, Foresters, I've seen a dividend sheet for the last 20 years from them where the highest dividend I saw them pay was 8.04%. That's pretty good, okay? So when we're earning the dividends are paying down the loans that we have. What loan? Well, here's the loan. When it comes time to pay whatever debt it is you're talking about, that car, pay the car off, pay the credit card off, do a mortgage chunk, pay your student loan, whatever it is. When it comes time to pay the car off, you're not going to send a check from your bank until you've taken a loan from the carrier. So if that bill was, let's say, $3,000 to pay off that credit card, you take a carrier loan for $3,000 and you pay off the debt. What happened? Your debt gets paid. You took a loan from the carrier. Whose money did you use? This should be an aha moment for you. The person's money or the group's money that you use is the carrier's money. Your money is still sitting in your bank, your DFL bank. You never pulled the money out, right? You took a loan. Okay, so that means that we did not limit the capacity for your bank to get that 4% guaranteed interest plus that dividend every year. We took some of the dividend away because you've got a loan, okay, but we didn't limit your ability to earn money with your money, and we never do. So every time we make a payment, that size of that pot of money that's getting the 4% dividend, the 4% interest rate plus the dividend grows and grows and grows every time we make a payment on our life insurance policy. So we're growing this every time the month goes by and they pay 1/12 of our 4%, it grows. Every time at the end of the year and they look at how much money we had in there in the form of how much cash did we have in our whole life policy and how much money do we have in the paid up additions, it grows again. So we're growing three different ways, and it is constant. And there's a point, and it's usually about year 2.2 to year 2.4 with these policies once they start, where this becomes a juggernaut. You couldn't stop it or defeat it if you wanted to. And moreover, when you get up with your Symmetry agent here, they're going to be able to structure this so that there's a point where you won't have to pay premiums anymore. And it's usually 5, 10, 15 years down the road. It's up to you, depending on how large of a retirement plan you want. But I've structured these where the people are only paying in for 5 or 6 years, and they're getting all their debt gone, including their mortgage, and they're still having a couple $100,000 for retirement. These things fly if you set them up correctly. So going back to the illustration on the page, you take a carrier loan, use that carrier loan to pay your debt. In the end, you paid the debt. The debt's gone. What happened? The carrier loan became their money. Your money is still your money. And that's a critical concept to what we're doing here. That's how debt-free life works. We're making your money. We're putting it into a private bank that you own, you control, you're the banker, and we're making it work for you for the rest of your life. As opposed to sitting into your Wells Fargo account, making the bank money until you tell them to use that money and having that money be gone. Okay, so let's go forward. So got a couple of examples I like to illustrate here about how we do this. And this is going to be a standard or traditional family. So here's a normal family this is actually a client that I worked with about last October. And this client has a fair amount of debt. They do. They've got student loans. They've got a residence. They've got a rental property because it's two families that were previously divorced. They got married and came back together. Okay, so there's two properties involved here. There's a lot of credit card debt. They tried a debt consolidation thing. That's that green sky loan there. So they've done this. They've tried to get out of debt, but in the end, they're still going to have this. They're going to have 40 years to pay off their debt, and that's because of the student loans that they have. If they could write a check today to pay off all of their debt, they'd be writing a check for $584,000. In the end, the way that they're on track, they can't do that. They're going to be paying this debt off over 40 years, and what they're actually going to pay to get rid of that debt is $767,000. You're going to pay $182,000 in interest. So what we did is we said, wait a minute, there's a better way. Here's the better way. What if I could show them a way to get out of debt in 7.8 years? And that's what this plan did for them. If you notice, see that middle column that says percent rate? That's the interest rate on some of those accounts. This is true debt snowballing. We are not choosing the highest interest rate to pay it off first. We are paying these off in a very specific order. Our software is what tells us the order. And our software is what goes through all the different permutations, all the different ways you could pay one off versus the other, and eventually get down to the point where it saves you the most money and creates the largest amount of income for you in the end. How did it work? Let me go through here. This is what it looked like for them. 40 years to be debt-free, have 100% equity in their properties, pay $182,000 in interest. Or use the debt-free method, bottom left, 7.8 years to be out of debt, save $70,000 in interest. But that's great that we saved them $70,000 in interest. But in this particular example, it's not the interest that we're concerned about. That $70,000 is a lot of money. But look what happens down there at the bottom. If they had gone through with their basic plan over 40 years, they would have zero cash other than the equity in their homes. That would be their retirement. In this case, we created $4.8 million in liquid money. And then if you take into account the size of the death benefit, because this is, don't forget, at the end of the day, this is a life insurance policy, and that life insurance policy grows over time. At the end of the day, when you add everything together, they would have had $5.9 million in combined assets between their death benefit on their life insurance policy and the cash value. And understand that number, that 5963, 5.96 million total, that includes a life insurance policy that's completely self-funded. They don't have to make payments on this anymore. It's already rolling for them. So let's take a little bit more. This is an example. This is the same people. This is what happened over time. Every one of those yellow bars is a year in which they paid off some debt. Okay, so the first year they paid off some debt. Next year they paid off some more debt. How much? You can see that middle column, loan from CV. So the first year they paid off almost $15,000. Second year they paid off another $15,000. Third year, boom, $58,000 in debt paid off. And then fourth year, because they're trying to build up some cash, they didn't spend anything. But look all the way to the right. What happened in the fourth year here? They grew $91,000 in cash. That's through the guaranteed interest rate with the money that was in there. That's not the dividend, because we don't illustrate a dividend on this. And that's with the snowball working for them. And then the very next year, they took a loan for $96,000 and paid off a whole lot of stuff. This is how the system works. We leverage a couple of different techniques. The technique is infinite banking, creating with the guaranteed interest rate, with a dividend on top of that, with snowballing. That's how this works. It's not magic. It's just math, and it's guaranteed math, guaranteed by the carrier. So this is the end of their run. So this person said he wanted to retire at 75. So at 75 years old, he made his last premium payment, and then he's off to the races. And he can take, just I want you to show, look at year all the way to the right, the annual liquidity column, year 41 and 42. In year 41, he had $5,051,000 in that account. And year 42, he had $5.254 million in that account. He didn't make any payments. That should be an aha moment for you. That means his account grew $200,000 just from interest without even illustrating the dividend here. Okay, folks? All right. So what about if you're not that person? What about if you don't have any debt? What about if you're just a student? This works for anybody. Everybody's got some debt, but this works. This is a student example. So the student example here, this particular student is 23 years old, I think. She has some debts. She's got some student loans. She's got a vet bill and a hospital bill. She's got a fair amount of debt for being 23 years old. Okay. She's got $85,000 in debt. And because of the way the student loans are structured, she's going to be paying on those for 40 years, especially right now. She's not paying them because she's not working and they're just growing interest. She is working, but she's not making payments on them. So really, in this case, she's going to pay more interest than she owes in her total debt. Wrong. It's not the way to do it. So our debt-free life system did this for her. We got her completely out of debt in 9.7 years. This is on an affordable plan for her. This is what she works as a waitress. This is her. She's basically spending 2 nights of tips to be able to pay this system down. And that's great that we're eliminating that debt. It's great that we're saving her $64,369 in interest. It's great that we're getting out of debt in 9.7 years as opposed to 40. All great. It's all fantastic. But what the kicker is for this is, what are we doing? We're creating a private bank that she owns and she controls. And whatever comes up in her life, she'll be prepared for. How so? Oh, by the way, in 40 years, she'll have $603,000 in that account. That's a huge chunk of change to retire with. It's much better than that 60,000 that we're looking at. So she's going to, in this scenario, at 63 years old, she'll have $603,000 in here. But here's the cool thing. She wants to retire early. She told me she wanted to retire at 60. I've got her retiring at 65. See down here at the bottom, 55, 56. At age 56, she's no longer making payments on this thing. Okay? Look at this. $431,000 in her plan at age 56. $454,000 in her plan at age 57. That means her plan grew $23,000 in 1 year without making any premium payments. That's just the interest. Again, I've said it a couple of times, these illustrations that we run, they do not have the dividend because we don't know what the dividend is going to be. We know there's going to be one. So in this scenario, this little 23-year-old who's working on a master's right now is going to be completely debt-free before she's 35 years old. And at that time, not only will she be completely debt-free, if she wants to, she'll be making $13,000 a year tax-free income on top of whatever she's making right now. Okay? So that's kind of the end of that little part of that presentation. I'm going to stop sharing for just a second. A couple weeks ago, we talked about mortgage chunking, and then last week we did some stuff about taxation. And so what I want to show you right now is I had people ask me again about the mortgage chunking piece. How does it work? So I'm going to show you how mortgage chunking works. Give me just a sec, and let me get that up. All right. So this is how mortgage chunking works. So I'm going to use that same family that we just looked at, that family scenario just a few minutes ago, because they have a nice round number for a house. Their particular house was $215,000. So I'm using that as an example of how to mortgage chunk a $215,000 mortgage and what it's going to look like. So this was their standard scenario. You've already seen this, already looked at this, nothing new. In this scenario, their mortgage, that personal residence, is going to be paid off in year 7.75, 7.8 years, right? So here's how mortgage chunking works. Getting through all this. All right, here we go. So we're going to make some assumptions. The first is that we've got a $215,000 mortgage that's a 30-year mortgage, which is exactly what this family has. In addition, we're going to assume that they've got some basic debt, which they do, and the majority of them are going to be paid off in 2.3 years, which they will. Last thing we're going to use is, this is a little bit less than what that family's actually doing, but we're going to assume that the debt snowball that we create, plus the paid up addition, stipulated annual purchase, is about $10,000 a year. That's $833 a month. So that's, remember, this is after that snowball is running. So all we've done is we've taken money that you were spending on a previous debt, and that debt's paid off. So we're rolling that amount of money back into our system, back into our plan. That's where we're getting these large numbers. That's where we're getting $833 a month PUA purchase. Okay. So this is a standard amortization schedule, and this is their amortization schedule, exactly, with their interest rate and the whole 9 yards. So one thing I want to point out, that first mortgage payment that they make is 74.71% interest. So all you folks out there that were told that you've got a 3% interest rate mortgage, or 2.5, or even a 5.5% interest rate, they all lied to you. The reality is your first mortgage payment is 74.71%. That's about normal. Your second mortgage might be 0.1% less than that. The idea here is that the only time that you're ever actually paying what they told you is really in the 30th year of your mortgage if you have a 30-year mortgage. But anyway, so I'm going to get off my high horse on that one for a second. All right, so this is their mortgage. It's $215,000 in May of 2020. In May of 2023, that's 3 years from now, let's assume what I showed you guys just a minute ago is that that particular family had $90,000 of cash sitting in their bank. Let's assume that we only have 10,000. So this is a much smaller program. This is probably the equivalent of maybe $100, $150 a month to start. Let's assume that there's $10,000 built up into your bank after 3 years, which is really easy to do. This is a mortgage chunk. We're going to take a $10,000 loan from our bank, and we're immediately going to send that check off to the mortgage company and pay $10,000 of principal. Okay? So $10,000 in principal means that we immediately drop the amount of money we owe on that mortgage from $203,000 down to $193,000. 203 minus 10 is 193. Okay? What else happened? So really, with that one $10,000 payment, we accelerated the mortgage 28 months. That's the first thing that happened. The second thing that happened, you see that third column where the $372 is underneath the red line and $767 is underneath on the left side? That's how much, the left side is how much principal you're paying, and the right side is how much interest you're paying. No, reverse that. Left side is how much interest, right side is how much principal. So where we were before at $332 and where we are now at $372, that's a $40 increase. We're making the same mortgage payment, okay? Nothing's changed. We're making the same mortgage payment. But every mortgage payment we make after we make that one $10,000 mortgage chunk, every single one that we make is now paying a minimum of $40 more principal per payment. That comes out to 10.1%. So what we did is we made every single mortgage payment after we make that first $10,000 payment pay more principal. So not only are we paying down 28 months of interest, not only are we making one $10,000 payment pay eliminate $22,000 worth of interest, we're now making every single payment after that work better for us and create more a system where we're paying our loan down faster and faster and faster. And guess what? You can do this every year. So when we looked at this screen where we're talking about how we got 7.8 years, this does not assume any kind of mortgage chunk. This does not assume any kind of dividend. When I'm making a $10,000 payment each year, every year, by the time I get to this 7.8 years where I owe 75, I've already paid down 10, 20, 30, 40, 40,000. This is only $33,000 worst case scenario. The reality is it's probably gone. So by mortgage chunking, you can usually eliminate another year or more of mortgages simply by making that extra $10,000 that's sitting in your bank. It's earning money, but you're not taking out your money. You're taking a loan. So by taking that loan, your money still sits in there. Your money's still earning. You're still getting that dividend. The dividend's paying off any loan that you have already. And then you're using their money to pay your mortgage down fast. So that's how mortgage chunking works. Let's see. So I'm going to open it up now. See if anybody's got any questions. If you do, go ahead and raise your hand or unmute yourself. So
hey.
Go ahead.
Okay.
Hey, Alma.
Yes. How are you?
Nice to see you.
Great performance.
Yeah, that was a performance?
Yeah.
Okay.
Excellent presentation. What I wanted to ask was, in chunking at $10,000 Are we talking like annually, or I guess when that money's accumulated?
Right. So yeah. So what I see is you can do multiple chunks per year, and you don't have to wait for 10,000. The only reason I use 10,000 is because that's what the illustration is that I showed. I've done them as small as $5,000, and I've done them as frequently as every 3 months.
Okay. Now, my real question was, now that has to be paid back. Like, how much would you have to increase that?
Does it have to be paid back?
I guess not.
Right. So the dividends with these vehicles are structured to pay back automatically. You can certainly pay it back, and there are times. This is where the agents and underwriters that do these things. This is where we have to educate the client, because we have to understand and we have to teach them. There's a time when it's appropriate to pay back a loan, and there's a time when it's not. So one of the key concepts I want you to think about here is these plans fly because of the effect of compound interest on top of the effect of the dividend. So I want to get, when I'm setting up these plans, I want to get as much money in there as early as I can, so that compound effect starts immediately, because we're getting that 12, the 4% compound it's compounding every month. So right. If I've got $100 in there in month one, and then I write a check for $5,000, and I've got $5,100 in there, that means I'm earning 1/12 of 4% on $100, and the next month I'm earning 1/12 of 4% on $5,100. So the concept should be to maximize the PUA every year as early as you can, and then start paying the loan back. That's going to that's the most efficient way, and that's also makes the thing grow the fastest. Okay. One other thing I want to say about this. Right now, the IRS just released guidelines that anybody with a 401k, 403, they can actually pull money out of their 401k or 403 without penalty right now, even if they're not normally eligible to do so if they're not old enough. So you can withdraw money from your 401k and use that to start one of these plans. And I've done that in the last week. I've done that 3 times. Okay. So it is a brilliant way to get this thing started. So when you're looking at the debts and you've got all those debts listed, and you're looking at, what are the smallest ones that I could potentially get to make that snowball start immediately? Brilliant. Perfect way to do it. Take $1,800, take $1,500, take $2,000, whatever it is. Put it in the account on day one, fund the PUA, immediately turn around 2 days later, take a loan, then pay off those debts, and then the very next month you're starting the snowball. That is the way that you make these plans fly. But just want to make sure everybody's aware that you can withdraw money now from your 401ks without penalty. You still have to pay the tax, but there's no penalty. All right. Let's see. Someone asked, which DFL carrier do I prefer and why? We've got 3. My go-to for everybody who's under age 70 is Mutual Trust. The reason why I like Mutual Trust is because they have, from my perspective, the best customer service available. So when I'm setting these up for clients, I want to make sure that the client's getting fantastic customer service. If I can't offer it, I want to make sure that if I'm not around or whatever, I want to make sure that they're going to have that. For anybody who's writing these for someone over age 70, you only have one choice, and that's Foresters, because they're the only ones who will issue a PUA rider. All right. I don't see any other questions. Anybody else? Oh, we got through it in a half hour today. That's awesome. I'm getting faster.
But can you hear me?
Yeah, I can.
Okay. I used to sell this plan. It was called a whole life with Mass Mutual.
Say again?
It used to call a whole life with Mass Mutual.
It is not Mass Mutual.
No, the one that I used to sell.
Okay.
Okay, and for the first 2 years, you cannot touch the income that you were putting in the program. Because of the dividend. And after that, then you can start using it like right. The way that you told me.
Okay. So what's your question?
Is it the same?
No.
No.
I've had withdrawals happen about 3 days after the initial checks hit the carrier.
Exactly.
Yep. There's also no limitation. If you're going to compare apples to apples, there's no limitation on the number of loans you can take per year. There's also a significantly reduced cost per loan when you compare this to a Mass Mutual or Lincoln or any of those other people that try to offer something similar. This is there's only 3 carriers that do this the way that this is supposed to work. So you've got you don't have they have to be mutual companies. The dividend has to be high, and they have to pay a high guaranteed interest rate, and they have to compound it quickly. They have to have the infrastructure built up in the back of the house to be able to support multiple loans frequently. So those are some of the other requirements that Symmetry had when we set these up. But good question. Thanks, Gustavo. Anybody else? George Kuhn, you look like you had a question there for a second. Or did you just look inquisitive? Okay.
Hey, Scott, it's Jess. How are you?
Ah, Lady Jessica, how are you?
I'm doing well, thanks. I did have a couple questions from one of my clients who couldn't be on today. He was kind of hung up on the loan situation, and I love that you gave us the mortgage chunking. That was great. When a loan is taken, what is the interest rate that is charged on the payback? If the loan isn't repaid, how does that affect the interest rate? Does it just stay on the loan forever? Right. I think I know the answer, but I want to get your take on it.
So the loan, it's going to differ. The interest rate is going to differ slightly from carrier to carrier. The average is 4.79% loan interest rate. Typically, the guaranteed interest rate plus the dividend is going to exceed that. So really kind of think of this as I'm going to pay myself to take a loan. Okay. So how does it get, what was the other part of your question?
If the loan isn't repaid, how does that affect the interest rate? But it does repay because it's not structured to automatically repay, right?
So here's how this works. And this is, so a loan, you have 1 year to pay it back. Okay. They will reduce the cost, the dividend. It's usually 0.65 or 0.95 points that you would get if you have any loan. Okay. If you pay the loan back within 1 year, they will credit all the interest that you missed. Okay, so that's how you pay it back. Do you pay it back, or do you let the dividend pay it back? It just depends. And like I said, there's in every case there's a best way to do it, and every case is different. So you have to do the math. So this is where you're going to look at how much is it growing, how much do I have in there, how much of a loan, when I'm going to pull my next mortgage chunk or whatever chunk. You can chunk things other than mortgages, by the way. You can chunk credit cards too. It works like a charm. Okay, so it just depends. And I hate to say, I'm not trying to be wishy-washy. It's just that is the case. That there is no one best way, but there's always a best way for each one individually. Right?
Thank you very much, as always.
Okay, how's Pennsylvania? When a loan is taken, what is the interest rate charge? Oh, that's from Jessica. Oh.
Yeah, it's beautiful here. I've been sitting outside all afternoon long doing work from outside. Loving it.
Awesome. Okay. All right. Mr. Deutsch, you got anything?
No, Scott. You know what? Actually, yeah. When we talk about setting this up to go generationally, being able to buy a house and et cetera, what are the ramifications of having, having a large amount of money in a debt-free life account when it comes to kids' college educations, like applying on the financial aid?
Using it to fund college?
What's that?
Using it to fund college?
Using it to fund college, but also not getting yourself out of getting any financial aid at the same time.
Okay, well, it's not considered an asset when that computation is made.
Okay, so kind of like when we do our Smart Start programs for kids, the money that accumulates in the Smart Start is not recognized by the financial aid program.
Exactly.
So they're not dinged for doing a good job or preparing. This is the same thing?
Yep. And here's one thing I want you to think about too. This is really cool. The cost of the college, you can make that work to your benefit forever. So if the college costs $10,000 a year, take the student loan if you want, if you don't need to, pull the cash out, pay it, and then pay it back. Pay yourself back over time. It's just instead of you paying either 6% or 6.5% that they're going to charge, you're paying 0%. And what you're doing is you're adding principal to your plan, which is equal to the amount of whatever debt, in this case, a student loan for college. So you make it work for you forever.
So that's expanding the bank, earning more interest, making the bank bigger and bigger and bigger.
Yep,
okay.
Exactly.
Gotcha.
And then moreover, one of the other things we talked about, generational wealth. How do you do that? Okay. Well, there's a time when we can see the writing on the wall, hopefully, and we know that something's going to happen to us. So at that time, what should probably happen is who's next in line? Who's the next family member or one or two generations down, and do another one of these plans on that family member, and then take out $300,000, $400,000, $500,000 as a loan, and then pay into that account over a couple of years and fund the heck out of that thing. And then you're able to transfer the wealth down 2 more generations.
Okay. I guess a follow-on question to what you just said then. I know that we don't have to repay the loan because the dividends will repay the loan, et cetera. But did you cover if someone passes away before the loan's repaid, kind of how the insurance company? Okay.
Yeah, so at its core, everybody, these are life insurance policies. So as a life insurance policy, when we structure them, we take into account the debt. How much is the debt? And so if someone takes out one of these plans and dies the next year, they should be structured such that it pays off all of the debt with the life insurance payout. That's why we have that. One of the reasons why we have that large term on top of the whole life component. And then the PUA over time, as the PUA gets larger and larger and larger, we don't need the term anymore. And we still have the same amount of life insurance over time. Then it drops down when the term goes away, but then it builds back up again because of the interest and the dividends that are being paid to it.
And if there's any loan balance, the insurance company pays themselves back first with the death benefit, right? Okay.
Yeah, but there will always be a payout. Okay. Because the whole life policy is always going to be there, and we're not taking loans against the whole life policy. We're taking loans against the PUA.
Gotcha.
And always be additional PUA because we're only ever accessing 95% of the total PUA value.
Okay.
Thank
you, Scott. Hey, Scott.
Yes, Mr. Kuhn.
Hey there. You mentioned about 401ks, et cetera, that they lifted the restriction on being non-penalized. Looking at your past and what you put in place, what's the best way to project whether to pull out or not pull out? Do you run the scenarios and see what's in their interest, their best interest? Because it's kind of like chunking into the plan, chunking into the bank.
So it usually starts with a question like this of how much have you lost in the last month? How much more do you want to lose? So that's usually how it starts. So always, this is another protective source, just like putting it into a private pension. It's the same thing.
So at this point in time, you would take out during these down times, the up times, maybe they decide to leave some in or turn it off?
Well, and this is where we have to I don't want to get into, private pensions, but there's a side to that. So there's a family we helped recently where they had a private pension. They had a 401k, but they had lost a lot of money. So all we did was we took some of the money to start their DFL, and then we took the rest of it, not the rest of it, but a lot of it, and moved it into a private pension. So we've done both. We've started the DFL for them so they have a better tax-free retirement, but by moving it into the private pension, we also stopped the hemorrhaging for what they were losing based on the market. And if the market turns around and goes up, great, we're going to capture all that move. If the market keeps going down, fine, because we've already insulated and not going to lose any more. Either way, it's the best of both worlds. We've covered every direction. We made them bulletproof. So that was the idea.
Okay, thanks, Scott. Good.
Yep. Okay. May I please know how to send this recording to my client? Sure. It'll be on YouTube. You can send a link. All right. Anybody else?
Hey, Scott.
Yes?
Yes. I have 2 quick questions. Number one, what if you were to put a large chunk of money into a DFL policy and spread that out over X number of years? Like, how would that affect the cash value accumulation? And number two, the second question is, are the dividends paid monthly or yearly?
All right, so I'm gonna start with number two because that's the easiest one. Dividends are paid annually.
Okay.
Okay. Now, how does putting a large chunk in here? This is where when you're planning these and rolling these out and doing the illustrations, you have to take into account a couple of things. You have to see how much their snowball is going to be, when it's going to start. So you're going to have to run multiple scenarios to see which is going to be best for the client. And then you're going to have to look at, okay, so I have a gentleman I'm doing this with right now. He's got about $200,000 he wants to put in here because he owes $200,000 on his house. He wants to put it all in here, pull it all out, pay off his house, be done. Can't work, okay? Because it will become a mech. So that's where you have to play it out. So what you'll say is, okay, look, we'll take, you can take it out, because he's old enough where he can retire now and he can do it. He can take out the money, just put it into an interest earning account somewhere. We'll take out the max. You will fund it maximally each year. And this is where you got to think, you got to think through it. You have to put that huge term life policy on there so you can maximize that PUA annual contribution. Okay. And you can still do the chunk. You can take the money out, put it into your account, your checking account, put in your maximum contribution, take that money out as a loan, do a mortgage chunk, make another payment up where you're paying off the loan that you just paid, make another contribution, do the same thing. So you can cycle through the money that way and get mortgage chunks paid.
Okay. All right.
From my perspective, it is not a good idea to use that kind of money to pay off a loan. Let the system work its magic on its own.
Okay. And then the last question I had for you is, historically, out of the three carriers, has there been a difference in the dividends that they've paid historically, besides for the customer service that you said earlier?
Yes. Yeah. And also the way they pay dividends is different. So for example, Foresters pays a combined dividend plus interest rate. Mutual of Omaha pays Mutual Trust pays a dividend on top of the interest rate, the guaranteed interest rate, but the interest rate is guaranteed, is a monthly compound. And then Lafayette, which is the third carrier that we have, they pay 4% guaranteed monthly compound, and they pay annual dividends. Foresters and Lafayette pay about the same rate on the dividend. Mutual Trust pays a little bit less on the dividend.
So which is better, just from that perspective, out of the three?
Well, when I'm looking at the illustrations, I know that when we execute these plans with some of the advanced concepts like the mortgage chunking and that kind of thing, they're all going to work out about the same. The fact that we're getting 0.05% less of an average dividend from one company or another is not going to make any difference, not in the long run, not appreciably. I mean, granted, $1,000 is $1,000, and in 30 years it will be $1,000 difference. But that's, when we're talking $400,000 of the growth, okay, because you got, for me and for my clients, the customer service aspect is critical. And I know, because I'm not going to, I'm in my 50s. I'm not going to be here 15 years from now, right? I want to make sure they're getting the service that, when they need it 15 years from now. And that's going to be Mutual Trust, from my perspective, as the best customer service of the three.
Okay. And last question, I promise. I know these are 100-year-old companies, but in the unlikely event that they go out of business, what's the guarantee?
Each state is a little bit different. There's so the state insurance boards have co-insurance requirements. So all the carriers, most of the time, co-insure each other's. They also pay a fee every year actually, to be able to offer business in those states. So there's a fee, kind of like the FDIC, to make you whole for the first $250,000. The states have that thing in place as well. So, but again, there's a reason why we only work with A-rated carriers, and there's a reason why you don't hear the insurance companies going out of business, which doesn't happen.
Okay, thank you.
Thanks. Yep.
If I could just kind of add to what he said, another thing to keep in mind when you're picking a carrier is how well the client matches that carrier's desired profile. So I'm doing one on my son, and one carrier wants to rate him because of a medication he takes, and the other just says he's standard and potentially preferred. So you're gonna go with the carrier that's going to offer the client the best as well. And And echoing what Scott just said about the longevity of these companies, I mean, I know Foresters very, very, very well. I have policies through Foresters on myself. And it's a 150-year-old company that has 11 to 12 billion dollars in coverage and over 15 to 16 billion dollars in assets. So they're what's called a fully funded company. Means if everyone drops dead tomorrow, they have enough money to pay everybody on hand right then and there, and then they still have another 10% minimum left over to run their company. So
Right.
again, the companies we're looking at for this, they're stalwarts.
Yep.
I guess is the best way of thinking it.
Yep, and they all operate in all 50 states. And
Yep.
And also something you just mentioned, Tom. Every company's got their own little quirks. So there's some really cool stuff about Foresters, especially when it comes to stuff when you're looking at family stuff.
Yeah.
And the program that we're using with Foresters has access to those family solutions with the orphan plan and all that kind of stuff.
Probably the biggest one for a family with young kids is if the kids become orphaned and their parents had Foresters policies, the guardian gets $900 per month per child until the child turns 18. And then when they turn 18, there's an $8,000 per year automatic scholarship set aside for the child to go to college or go to a trade school or, however they're going to use that to further their education. So especially with my families that have young kids that I'm talking about doing this too, Foresters is my number one go-to.
Absolutely.
So.
Okay. Anybody else? Looks like we might have made it. The goal was to be off and be done by 7. So Thank you, everybody. Thanks for coming. Hopefully you got something out of this. We'll be back next week. Next week, we're going to dive deeper into the college aspect and how you can fund college.
Hold on just 1 second.
Planning with us. All right, folks.
Hey, Scott, thank you. Thank you so much for taking the time tonight. Really, really appreciate it.
My pleasure. Great job. Everybody have a good night.
Thank you.
Thanks, Scott. Thank you.
Golf clap.
Thanks, Scott.
Bye-bye.